Hey guys, how's it going? Hope everything's going well. I haven't done a video in a while. Part of the reason the wife and I are moving out of the condo that I previously owned, and we're moving into a bigger place, a house. And in addition to that, my rest of the free time is spent on writing articles for Seeking Alpha. Where, yes, I do get paid for that, not too much, but it also helps me out in researching items that I never would have thought of before. So, yeah, I get paid, and then in addition, I learn more information. And for the YouTube videos, I do some research, but not as much as I would do for those articles. So, check them out. I'm going to put a link on the YouTube video below, and you could see what I'm talking about. Sometimes what people say about my videos, oh, you didn't say this in your video, or you're not being too clear. The articles, I feel, explain more than what's going on in my head, because sometimes what's going on in my head, people may not understand that. People don't have ESP power, so they can't clearly read what's going on in my mind. But I wanted to get to this article on Zero Hedge. FX positioning hits multi-year extremes as dollar tumbles, euro soars. And when it comes to FX positioning at multi-year highs, or if you want to look at the non-commercial speculators in the futures market, I view them, and other smart money investors view them, as dumb money at position extremes, especially if they're the most long or the most net short ever. This is what happened with the Canadian dollar earlier this year. I did a video, there were a few other people that did videos on that as well. And you can see the Canadian dollar has ripped higher. I think 1,000 pips. I mean, not 1,000 pips, but if you look at the futures contracts, right, it went from 74 to 79. So that's pretty good move. I didn't make money on all that move. I made money. I didn't make that much money. I usually kept my oil spread positions with that because the Canadian dollar and oil are linked together. But I want to get into this article about this FX positioning for the dollar and then the euro. So, as I mentioned before, the euro or the dollar index is a basket of fiat currencies, and 57% of that is the euro. So, if the euro goes up, dollar will most likely go lower. And this is what we've seen. I did talk about last November how rate hikes, when the Federal Reserve raises rates, this is actually bearish for the US dollar and bullish for the euro. And I was right on that thesis, but I didn't execute my trade to the extent that I wanted to. And what has surprised me is that the euro has gone to 117 right now. I've looked at the smart money versus the dumb money. It talks about in the Zero Hedge article. So it talks about uh, specs are turning more bullish on the euro at 91K contracts, highest net long exposure since 2011. I did look at the commercial futures hedgers too, regards to the euro. I'm going to do an article about this on Seeking Alpha. Hopefully, it gets published in the next day or two. And it's regarding the strange intermarket relationship between Costco and the US dollar. And I expect a bounce in Costco because the dollar, in my opinion, is going to rally, right? Even though it may not rally significantly, it may not reach the highs of this year at what, 102, 103. But I do expect Costco to go up and the dollar to rise very shortly. And the reason why I expect it to rise is because the commercial hedgers are the most net bearish since 2011, and the FX specs, they're the most net long euro since 2011, right? Specs and non-commercial money, those guys are dumb money at position extremes, and we are reaching position extremes. I did do research on this, and I believe 100 net short 118,000 contracts for the euro. The most ever that these commercial hedgers have shorted is approximately 141,000 contracts. So they're getting up there, and this is data as of last Tuesday. So you saw the rally late last week in the euro. So I think the commercials did add more short positions to that, while the individuals that were selling the euro calling for parity, now they're very bullish on the euro. So just take a note at that. And the other pair that I find interesting is the Japanese yen. And let me go find it here. Okay. It does talk about how the speculators have gone net short yen. They increased their net short position for the fourth week to 127,000 contracts, the highest since January 2014. That's when the yen actually rallied, right about that time. There wasn't a significant rally, but there was a rally. And what I've noticed, and I talked about this in my Seeking Alpha my Seeking Alpha article. I talked about a gold rally potentially on its way. And the reason why I think it's on the way is because, we've seen it bottom from what, 1220-ish to what, 1250 right now. And it's solely, in my opinion, looking at the Japanese yen. The Japanese yen and the US dollar, Japanese yen and gold have a positive correlation since 2010. And I break it down in the article here, but last week, as of July 11th, they were net long 133,000 contracts. And I looked at the data as of July 18th, which was last Tuesday, which the CFTC released, and they're net long 147,000 contracts. So why is that significant? Well, the most ever long positions for the Japanese yen by the commercials was approximately 170,000 contracts. That is huge, right? And during this resumption of the bull market for gold since 2015, this is up there in terms of net long positions. So if you want to look at what these guys are doing, the commercial hedgers, they're buying yen and they're covering their short positions in the gold market, right? It's not to the extent that you saw in 2015 where they only had negative 2,500 contracts short. You're not there. But they are they are covering their shorts, and hedgers are going net long yen. And as I described over here, the gold and yen, they react similarly to real interest rates. And if real interest rates decrease, the better off it is for gold and yen, assuming that we are in a normal economic environment. If you are in a 2008 economic environment where everything is crashing, then you could look at this relation and throw it out the window. Because the yen rallied and gold fell in 2008, right? The yen carry trade unwound. And it appears that based on what these hedgers are doing, they are pricing in future or short-term negative real interest rates, which would be good for gold and yen. So yeah, that's what I think. Expect a gold rally. I did have a put position. I sold a put in the futures market. I got rid of it. I want to get back in to that. It was 1175 put. Made some money. I want to get back in. And then I do have various gold and silver positions to the long side and upside, right? But anyways, guys, take a look at this. Take a look at my other videos, articles, etc. And then I'll talk to you later. All right. See ya. Bye.